Good morning, everyone, and thank you for showing such keen interest in the renewable energy sector. The energy transition seems to be in the news all the time at the moment, so a really great opportunity to discuss it. As Nick said, my name is Minesh Shah. I'm Managing Director for the Renewables Infrastructure Group, or TRIG for short. I work for InfraRed Capital Partners, the investment manager of TRIG. As Nick said, TRIG is a £2.5 billion renewables investment company. We have an 11-year track record of paying a progressive dividend, which is currently about a 7.5% dividend yield, and delivering NAV growth as well. In this session, I'll cover both the rationale for investing in renewables infrastructure, as well as going into a bit more detail on the core strategies we employ to drive returns. So renewables investment companies like TRIG, they sit at the nexus of the megatrend that is the energy transition, with investor objectives for resilient, inflation-correlated returns that come from a combination of progressive income and capital growth. And TRIG offers a liquid way to gain access to what is otherwise illiquid and very large investments. In the case of TRIG, we leverage the expert management team of InfraRed as investment manager and RES as operations manager. And our team is some 30 dedicated individuals, but we're actually able to draw from the wider organizations as we require. Now, TRIG is relatively unique in having two managers, and having RES as operations manager at the top table is a key USP of TRIG. I mean, RES have been in the renewables industry for 40 years. I think before many of us even knew what wind turbines were, we still thought they were windmills producing grain. They have 4,500 people globally, which means we can draw from their experts. It's engineers, it's meteorologists, it's machine learning experts, and so on. And all of this is in an effort to drive value for shareholders. As Nick mentioned, TRIG's portfolio is diversified across three mature technologies, which have a proven returns profile. The wind and solar assets, they generate electricity, and they're paid for this either through a fixed price arrangement or on a merchant base, i.e. they're selling the power on the open market. In our portfolio, and a growing part of our portfolio, are flexible capacity assets, such as battery storage projects. These respond to price signals. They're complementary to the generating assets, and they make money effectively by buying electricity when the price is low and a lot of renewables are generating on the system, and selling it back into the grid when the grid needs more electricity, when supply is higher, say in the evenings when we're still turning on our kettles. And so in doing so, they smooth out the variable generation of renewables. So how can we make the most of owning these assets beyond their inherent characteristics? And this is all about active management. It's what we as a team of 30 individuals who are dedicated to TRIG do, as well as when we're drawing on the wider organizations. Firstly, portfolio profile. It's about the shape of the portfolio. And this is not just about managing risk through geographic, technology, and revenue diversification and so on, but also about new investments, what are the new investments that we're adding to the portfolio, as well as the willingness to sell assets at the right time. And I'll touch on that in a bit more detail shortly. The second pillar, development and construction. Now that really draws on the core strengths of both InfraRed and RES. And this is about creating new infrastructure, new renewables capacity, and in doing so, accessing higher returns that come with that. And then finally, value enhancement. And this is about getting more out of the assets that we already own. It could be through increasing the energy yield, reducing costs, or making our operations more efficient. And over the next few slides, I'll dig into each of these in a bit more detail. So starting with portfolio profile, TRIG's portfolio, I mean, our remit is Europe, and our portfolio is 60-40 UK and the rest of Europe. And that really reflects that the UK has led the way in the deployment of renewables and is now leading the way in the deployment of battery storage. And we expect this ratio 60-40 to remain there or thereabouts going forward. Now, the portfolio is 82% wind, 13% solar, and 5% battery storage. And then this is an area we do expect to evolve going into the future. We're seeking to introduce more solar and more batteries into the portfolio just to provide further balance to it. And then over the past year and a half, we've actually sold about 7% of our portfolio for £210 million at an average 11% premium to carrying value. And that directly flows into improving the NAV. It's showing really the disconnect between what private markets are willing to pay for these assets and where the share price is trading. And this return of capital through the sale of assets has also underpins our buyback program. Now, we see buybacks as an attractive investment opportunity in the current macro environment. And for us, what they do is they set a return hurdle against which we measure any new investment decision. As a result, it means the new investments we're making, we're typically expecting double-digit returns from, so really helping drive portfolio performance going forward. And this includes a really interesting, exciting investment we made back in February into a company called Fig Power. That's 11 people based out of Bristol, and they have their own proprietary pipeline and are looking to build 0.5 gigawatt of new battery storage projects. So the second pillar I touched on was development and construction, and this is a key growth lever for the portfolio. And again, leveraging the core strengths of infrared and RES. Now, since IPO, we have built 650 megawatts of new capacity. That's nearly a quarter of our portfolio that we've built ourselves. And we've spent 270 million on construction development in just the last 3 years alone. And you can see some examples on these slides. I mean, they're really exciting projects. The Cadiz Solar, 4 solar parks, which together are kilometers by kilometers wide. The Twin Peaks onshore wind farm you've got there in the third picture, some of these turbines are approaching 200 meters tall, really quite incredible structures. And looking forward, we have a 1 gigawatt pipeline that we're looking to develop by 2030. That's about 600 to 800 million pounds of new capex. And crucially, it's our strong balance sheet that means we have the resources to fund this capex without necessarily needing to return to equity markets, from a combination of retained cash in excess of the dividend as well as debt capacity. And finally, it's not all about adding new elements to the portfolio. We also seek to make the most of what we have. And here we really benefit from RES's capability to make our assets work the best they can. And this encompasses both increasing yield as well as optimizing operations. And there's some super exciting developments in this sector, including leveraging Formula One technology to take leading aerodynamics and apply it to wind turbines, to improve the aerodynamics of the wind turbines and extract more energy from the wind. And the machine learning experts, what they're doing is getting the turbines to talk to one another so that instead of each turbine trying to maximize its own generation, the wind farm acts as a collective and seeks to maximize the generation of the wind farm as a whole. And I think that's really exciting stuff because your front turbines, they know exactly what wind is coming and they can tell the turbines behind them what wind to expect so that they can optimize their output even better. So just bringing this short presentation to a close and conscious wanting to leave plenty of time for questions, our proposition at TRIG is founded on 4 principles. Firstly, the expert management team of InfraRed and RES, combining our InfraRed 25 years of infrastructure investment pedigree together with RES's 40 years of operational excellence. The scale of TRIG, over 3 billion of assets, means we can effectively diversify the portfolio across markets, as well as taking attractive high-return positions without overexposing the portfolio to any one investment, managing concentration risk, and that's really important. Our strategy, which we've outlined today, is a total return strategy. It's combining what is currently a 7.5% dividend yield with that opportunity for capital growth. And all that is founded on a robust balance sheet with modest gearing, limited interest rate risk, and limited refinancing risk. So look, standing back, we're all really excited about the energy transition and the investment opportunity it presents. So thank you very much for listening. I'm very happy to take questions.
Excellent. Thanks, Minesh. I can see we have quite a few questions already, and you've left plenty of time for them, so thank you for that. Very concise presentation. We've also got questions online. If we could start off with this gentleman here, please.
Have you any thoughts about moving into hydrogen?
Yeah, so the wider parts of the InfraRed and RES business look at the perhaps less mature technologies, or those technologies that don't necessarily have a proven business model. So it's certainly a sector we're monitoring. It clearly would fall into that kind of flexible capacity and storage bucket. But at this time, without the kind of the business model in particular being proven, we're not looking to yet bring it into TRIG. But definitely one we'll be monitoring.
Got a lady here.
Thank you. This is an environmental question. Oh, thank you. This is an environmental question, and I only realised it when I was listening to Bobby Kennedy, and he was talking about in the US, there is a danger of wind blade debris and it cutting the sea creatures and damaging the environment. What is the situation when your blades actually start to decay, and how do you manage that there is no environmental impact, please?
Yeah, I think the first thing is to detect any blade damage, any blade deterioration before that even happens. I mean, our colleagues at RES have just acquired a new company which uses drones to inspect blades. That's reducing health and safety risk. It's also making those inspections more efficient. And what that allows you to do is undertake proactive maintenance to reduce perhaps the kind of wear and tear that you're suggesting, and also kind of nip issues in the bud. From a financial perspective, what that's also doing is improving your availability of the asset. It's improving the generation, reducing downtime. So both kind of positive environmental consequences as well as improving shareholder returns as well.
Thank you. Yes, please.
Well, thank you. I'm a very happy TRIG shareholder. My name's Marcus Rand. I wanted to ask about battery storage and a couple of quick questions. Firstly, sort of by 2030, what proportion of the portfolio do you see assigned to storage, battery storage? And secondly, I'm also an investor directly in the battery storage sector, which has gone through some pretty rough months recently. So while I wasn't surprised to see you move into that sector, I was a little bit alarmed. So I kind of want some reassurance really as to how you think you're going to do it without, let's say, undermining shareholder value and actually adding some shareholder value, given the regulatory problems that the sector seems to have to actually do their job of balancing the system at the moment.
Well, actually, the answer to both questions is linked. By 2030, hopefully about 10 to 15% of the portfolio is in battery storage. Of our development pipeline, about 600 megawatts is batteries. So if we build that, that would take us to that 10 to 15%. In being that kind of minority of the portfolio, what you're doing is not overexposing the portfolio to what is fundamentally a more volatile revenue profile, but that also comes with higher returns. So the wider portfolio can then absorb the more fallow periods of battery revenues like we've had earlier this year, but then a portfolio as a whole can then benefit from the higher, longer-term returns. From a portfolio construction perspective, it also is a risk management tool in that the more renewables are deployed, then renewables tend to generate all at the same time, which means the power price they end up capturing is lower. But when you have more renewables on a system, the power price is actually much more volatile, so batteries should do better.
Assuming they can get onto the grid.
Right.
The problem at the moment is they can't get onto the grid.
Yes, so addressing that in particular, I mean, there was a big trumpeting made of National Grid's announcement in the autumn last year that they were going to reform how the balancing market worked to improve the participation of batteries. I think the challenge was National Grid had always said kind of, this is a 3-year program to improve our systems. And then there was an element of the market thinking it should be fixed overnight. So I think people were left a little disappointed as to how quickly things have moved on. But just to put it in terms of numbers, before that, batteries were participating perhaps 5% of the time in balancing market. It's already up to about 10%. And kind of our revenue requirements need it to get to about 15. So you're already a lot of the way along the journey. The first of the batteries that we're looking to build, we signed off on the start of that build earlier this year. Shovels are in the ground. That's expecting to come online back end of 25, early 26. And then we should hopefully have batteries coming online every year thereafter between then and 2030. So we're also spreading vintage risk, which means as the revenues evolve, we're making investment decisions based on the knowledge at that time. I think what you're also seeing in the battery space is an oversupply of batteries to the actual kit. And so we're also seeing the cost of batteries come down quite significantly. The batteries we procured at the beginning of this year compared to the ones we're procuring for the next project probably about 20% cheaper than the ones we procured earlier this year. Now, you have to get on and build it because you've got a grid connection date to hit. So you kind of sign the contract when you need to. But you can see that cost curve coming down as well, which clearly, when revenues are more volatile and are more uncertain than on renewable generation assets, is helpful. Does that?
Yeah. Well, one slight question on that. Are you going to spread your battery technology across different countries, or is it all going to be focused?
So the question, just for the online audience, they can't hear you unless you have the mic. So the question was, are you going to spread your battery technology over different countries?
Yeah, so in the first instance, the UK, given the UK has the most mature revenue business model for batteries, it's also where we have a lot of our our power price exposures in the UK, so that hedge applies. But there's other countries where it would be relevant. Take Spain, for example. There's expected to be a huge build out of solar. Solar generates in the middle of the day. A lot of the demand happens in the evenings when we all switch our kettles on. You're going to need batteries to shift that load from the day to the evening. But we're not quite there yet on the business model, but it's something we're watching closely. And when we think that's there, we'll think about making that move.
I know we've got some more questions in the room, but we've also got quite a lot online. So I'm just going to take some questions from online. So the question is, when interest rates were zero or near zero, you were trading at a premium. As interest rates fall again, perhaps to around 3%, will you go back there?
I mean, that's for the shareholders and the marginal buyers and sellers to decide. I think what we've sought to do is set up a business model that is not dependent on where rates are. From a balance sheet perspective, the vast majority of our debt is fixed rate and amortizing, therefore no cash flow risk to interest rate movements and no refinancing risk, therefore fairly conservative. And this move into higher returning assets, construction and development assets, is actually a move we made in 2022 before interest rates turned, recognizing that shareholders were looking for a total return strategy, also looking to leverage infrared and RES's strengths. So we think the business model is fit for where rates are at the moment. It should hopefully benchmark even better if rates start to come down.
Would it be oversimplifying it to say that given your new strategy, total return should be higher in future on an NAV basis?
Yeah, so the discount rate that we use to value the assets has already increased. It was 6.7% 2 years ago. It's 8.3% today. So that's already a significant increase. And then all the aspects I spoke about today, those kind of three strategies, are all about delivering returns in excess of that. And you've seen even from the asset sales that, whilst we've struck the NAV where we have, we've sold 7% of the portfolio at 10% in excess of carrying value. So there is value to unlock in the portfolio.
Excellent. There is a question over there. Yes, please.
As an investor, clearly having dividends is a very attractive thing, provided one isn't eroding one's capital. And looking at a source of information, if I'd invested with you 5 years ago, I'd be 22% down. 20% over 3, over a year down 5%, and that's not an encouraging picture in many ways. I wonder if you could comment on that, and also with a peripheral look, to be fair, at your financial progress. The last set of results showed a loss, having previously made good profits, and I wonder if you could comment on that possible anomaly and why and how it might not happen again. And thank you very much for your time.
No, thank you for your question. Thank you for being a shareholder. I can understand from shareholders' perspective that the last 18 months as where the share price performance has been frustrating. I think a lot of asset classes have seen valuations come off regardless of whether they're equity or even if you were a fixed income investor 2 years ago with rates having gone up, those valuations have gone down as well. But if we look at in the context since IPO, the dividend has continued to be there throughout the economic cycle and continued to grow. So effectively, that dividend is being paid, whilst we believe that hopefully the share price does revert to NAV and improve beyond that. In terms of the financial performance, I mean, the challenges in the investment company world, the approach to accounting really is the movement in the fair value of the portfolio, which is why we've increasingly highlighted underlying cash flows in our disclosures. And you'll have seen that last year was our record year in terms of cash generation. And this year has been good as well. We increased the dividend by almost 10% over the last 2 years. This year we're expecting the dividend to be covered, but also expecting to reduce debt by 200 million on our amortizing debt and 200 million on our floating rate debt. So the business is cash generative, and it's how the accounting works that there's a disconnect between the cash generation and the performance of the portfolio versus the kind of IFRS earnings. Does that answer your question?
Thank you. I know we have a question there, but I don't want to discriminate against this side of the room just because I'm facing this way. So are there any questions from this side of the room? Yes, please, gentleman here.
Thank you. You mentioned some new projects. I may have missed what percentage of the fund is invested in new projects, and how long is the pipeline on average, or, generally, before they start earning revenue? So how much money have you got tied up for how long, basically?
Yeah, no, fair question. So from our investment policy perspective, we can take up to 25% of the portfolio at development and construction stages. So that's kind of the limit. In practice, at the moment, what we have in construction is only about 5% of the portfolio. We do have a 1 gigawatt development pipeline, which we'd look to take into construction, but that's over the next 5-6 years. And these assets are typically build period of, that battery storage could be 1.5 years, wind projects 1.5 to 2.5 years. So typically the kind of the capital expenditure is not kind of locked up for very long until it actually becomes a cash generating asset. But we're very mindful, and as we take the exposure, what is that doing to cash generation, dividend cover, being able to continue with the progressive dividend, and we'll continue to focus on that as we go forward.
Excellent. Yes, please.
My question is essentially the same as the gentleman just here, but it seems to be the decline in performance over the past 5 years seems to be a whole generic problem. I'm not an investor in Trig, but I am in one of the rival companies. That's gone down even more over 5 years. So what is the evidence that, you know, the bottom has been reached and we can expect better returns over the next 5 years than we've had in the last 5?
I mean, I'll just speak about the fundamentals of the business, and I'll come back to the fact that the business has been cash generative. We are systematically repaying debt and de-gearing. Our portfolio gearing at the moment is 37% of EV, which itself is modest. And if we did nothing else and just continue to pay the debt and the progressive dividend, then that gearing would be about 23% by 2030. So I firmly believe that if you start with a robust balance sheet, then success will come from there. We are seeing a disconnect between public market valuations through the share price and private market valuations through the sales that we've been doing. We're continuing to progress those to continue to evidence the value that is in the portfolio.
Excellent. A question online here. What impact will the new Labour government have on your activity? If any.
Look, I think what's important across the board, whether it's the Labour government, even governments in Europe, there's a recognition that the energy transition is important. And it can be for different reasons. Some are focused on the decarbonisation element, others are focused on energy security, but there is a general recognition that it needs to happen. What is helpful is in the UK, there's an increasing recognition that grid infrastructure is needed to support the energy transition. And actually, we're already seeing the benefit of that in our portfolio. We have one project, a 100 megawatt battery storage project. It had a 2031 grid connection date. We were able to demonstrate that it was ready to build, and we're able to bring that grid connection date forward to 2026, 27. So creating value by demonstrating that we're ready to build when perhaps others in the queue are not. So I think that is important. The other piece is clearly there's a recognition that the whole economy needs to decarbonize, and this need to transition from burning to electrification. I mean, if we just take London as an example, before the election, the debate was whether the ULEZ zone should exist or not. That question is now off the table, and the question is, how do we get to EVs and EVs faster? That will create demand for electricity, which should be good for renewables.
Excellent. We have time for one very quick question and quick answers. The gentleman over there, please, in the second row. Thank you.
Hello. Can you talk a bit more about the reported problems of buying things like high-energy cables for all your grid connections, and from wind farms onshore, etc.? There are often reports of there being very few cable manufacturers around able to satisfy orders.
It'll be a very quick answer, I'm afraid.
Yeah, look, I think it's well understood the challenge, the grid connection challenges. We are reasonably conservative in our approach to taking new positions and building new projects, and we want to make sure everything is lined up before we get to that final investment decision and really commit all the capital. So that factors into our thinking when we're making those investment decisions.
Excellent. Thank you very much, Minesh. We got a really good insight into Trig there, so thank you for your time and answering all these questions. I'm so pleased we got so many questions as well and we had time for them. So if you want to stay in here, and I hope you will, there's going to be more renewable energy infrastructure for you. We're going to have a panel discussion. We're going to go into all those questions, sort of questions in more detail, I'm sure. But if not, you're very welcome to move around and go to other rooms. But thank you very much for coming and attending this session.
Thank you, everyone.